Hello guys, it's your guy Brian here. So today we are going to look at market maker modules. Okay, when looking at a chart, you have to ask yourself which way does the price want to deliver. In doing a top-down analysis, you should be able to create a higher time frame thesis of where price is trying to go. Only then can you strip the price action down into lower time frames. We are going to take what we've discussed so far and slowly put it all together. Market maker modules, what are they? Okay, so is price action random or is it delivered in a controlled manner? Some people will argue that it is a random, others will say it's controlled. The reality is most of the market makers are delivered via algorithms on a daily basis. And because of this, we are able to use our understanding of liquidity and how price moves to give ourselves a fighting chance to trade alongside the algos. That's all that really matters. So as we continue, make sure you watch the full video on YouTube. We'll be doing classes there. I don't know if they will be helpful, maybe. Okay, let's continue. There are two models that you are primarily interested in for this lesson. Market maker sell models, or what we call MMSM, and the market maker buy models, MMBM. Okay, are the ones where we'll focus on as these models repeat themselves every day. Let's go to the template of model MMSM. Okay, this is the sell model. As you can see, this is how it looks like. You can have a general look of how it looks. Okay, this is now for the buy. You can see how it looks like. Okay, make sure you subscribe to the YouTube channel for more PDF formats. Market maker models, how do they work? This model works. These models work based on where the draw on liquidity is on and whether it is at low resistance liquidity run. All this means its structure should support the direction of the price and not opposite. Okay, the different draws on liquidity provide us with a possible narrative, the market structure, and that is what guides us in our reading of higher time frame price action. Okay, let's go now to a general idea of the sell model. The price expansion downwards towards the sell side liquidity. This is what we mean basically. Liquidity pool, equal lows, fair value gap, voids, okay, old highs, old lows, mention them. Before taking a trade, do you spot the optimal trade entry, or what we call the OTE? Do you spot the silver bullet, the second entry? Retracements into the fair value gaps are where shorts will be redistributed. The markets, we said it does two things. It either goes for the old highs or the old lows, or reacts on a fair value gap like here or here. Okay, let's go now to the buy one. As you can see, the same questions you should be asking yourself. Do you spot the optimal trade entry? Okay, do you spot the silver bullet, the second entry? Pullbacks into the fair value gaps. One thing that you should know, for both models, price will be looking to expand toward the draw on liquidity, either on the sell side liquidity, or what we call external range liquidity, or what we call the sell side or buy side liquidity. In doing so, it will create fair value gaps and order blocks, as you can see here, like this. This is what we are talking about, giving us a chance to add into the model trend, giving you any trader a chance. If you are in the buying side, you'll be given a chance to enter. That's why the market is moving up, then retracing to the fair value gap, moving up, then retracing to the fair value gap. So any moment that you want to take a trade, wait for the market to go back to your entry point. Okay, our range of opportunity is from the point of start of the model to the end of the target liquidity. Anytime you take a trade, always be targeting the external range liquidity, which is here. It is marked with an X. Okay, let's dive into each model with a more detail and specificity. Use the interbank price delivery array. This is basically for ICT combined with price action. What is the specific draw on liquidity? Old highs or lows? Liquidity pool, equal highs or lows? Old PD previous day arrays and inefficiencies, imbalances such as CB or BSI, fair value gaps, voids, gaps. This gap happens when the market opens, basically. Seeing the initial base of the buying models come from the impulse move lower into a higher time frame discount of an array, and then displaces and creates a market structure shift upwards. Okay, paired with reasons to reasons to move higher. Mostly, you will find that the market will go for the higher liquidity, or what we've called the external range liquidity. Internal range liquidity is basically what we call fair value gaps, and that will be a lesson for another time. You have a look at this before we can jump to the next slide. There you go. Also have a very, very nice look at this one. You are adding into internal liquidity. Internal liquidity, we've said, is basically what we call fair value gaps and order blocks. And mostly it's the fair value gaps, and are selling for profits in external liquidity. External liquidity is what we call external range liquidity, or what we call the buy side or either the sell side liquidity. Internal liquidity refers to the area inside a swing high and a swing low in any time frame. That is, when price breaks the swing high or swing low, it has moved from inside of the range to outside of the range. Therefore, it is known to have moved from internal liquidity to external liquidity. Why does price move this way? When price drops into a discount, sellers are being absorbed by longs into in liquidity. This is known as the accumulation phase. Which I told you, another lesson that I'll be teaching you is the 3 phases of ICT: accumulation, manipulation, and distribution. That will be a lesson on its own. There's usually a quick drop followed by an energetic displacement up. And once the market moves with a big displacement, the market never lives in balances. So it must come to that point. And that's why you see the market, even if there is an impulsive movement, it is forming fair value gaps and leaving order blocks behind. Okay, this could create the initial market structure shift. Okay, let's go to the next slide. Once this happens, you will use the market structure to add the trend. First, after that, you'll be looking for order blocks or fair value gaps to add into. That's where you join the trades into. Okay, in doing so, you will reaccumulating long positions with smart money to target higher time frame draw on liquidity. Okay, understand this. External range liquidity, or the sell side or buy side liquidity, is evident on the higher time frames than on the lower time frames. On lower time frames, that's where you find the internal range liquidity, or what we call the fair value gaps. This is where longs will be. We look to exit. That will be your buy stop. If you are taking buys, that will be your buy stops. And if you are taking the sales, that will be your sell stops, or what we call take profit. The buy stop, if you're taking the buy, that is what we call the take profits. From here, price can base and move higher or set up for a reversal. From after taking the external range liquidity, price might be tempted to come back. Okay, let's go to the next slide. Just have a look at this one. This is for the sell side liquidity. You can see a big displacement here with lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Okay, you can see here there's an optimal entry point where or what we call OTE, and you can see there are fair value gaps being formed here. This is where basically you find internal range liquidity, where you find a lot of fair value gaps. Let's go to an MMSM. Usually starts with an impulse movement higher into a higher time frame. Premium of an array, it starts here, and it goes into 3 phases. We'll come to that: accumulation, manipulation, distribution. Okay, from here, price will displace and create a market structure shift down. Here it is. You can see the market has shifted, and once it is shifted, it left a fair value gap here. That's one thing I'm very sure, it must leave an fair value gap here. Okay, this will signal the start of the MMSM. Price is being distributed during this process. Okay, shorts are positioning themselves for a bigger move down while allowing long positions to get out. Notice how this model likes to set up in a premium of a previous day array. Just have a good look at this one. I told you the external range liquidity happens on higher time frame. And the higher time frame, that is where we basically have our extreme points of interest. Okay, as price retraces back up, it enters supportive structure of the trend down towards our draw on liquidity, or what we call external range liquidity. This is an opportunity to capture some of the range towards our final target. Okay, the supportive structure to enter is at the fair value gaps and order blocks. So before entering a trade, just identify the order blocks or the fair value gaps. That's where you will rejoin the sellers, but don't just go into the market blindly. This is called redistribution. This is where smart money will look to short if they haven't already. This is our opportunity to join the trend alongside smart money. Let's go to the next one. Just have a good look at this one. You can see here, after the market shift, it left a fair value gap, but as I had told you, this is what we call redistribution. Then there was an impulsive movement here, leaving a fair value gap here, and you can see the market came to that fair value gap, then redistributed, going to our external range liquidity. It is basically that one. It is clear, you can see it. The key is to identify the market maker modules. Higher time frame analysis of liquidity. Okay, then go to 20, 40, 60 day. Look back periods of all liquidity. Start from the higher time frames, going to breaking it down to lower time frames. Another one, annotate the previous day array. This will identify either the previous day low or the previous day high. Before taking any trade, just identify. This is, let's assume this is your previous day low and this is your previous day high. Just mark them first. Are we in a premium or discount array, or are we in either this low or this high? Another thing you should be checking: has the price taken out a key higher time frame liquidity? Before taking a trade, ensure that one liquidity or the one external range liquidity, either the sell side or either the buy side here or the sell side, has been taken before taking a trade. And once it has taken it and it has formed a market structure shift, then know the market with heading down to take the sell side liquidity. Okay, and lastly, look for displacement and market structure shift. This will give the signal of which market maker modules is developing. Lastly, allow the market structure to guide you and exist. I'll go into each modules later in other lessons. Make sure you subscribe, hit that subscription button, like, share, and comment. Let's meet another time, guys. Cheers, guys.